Morning, everybody. Well, thank you very much for inviting me. It's a real pleasure. Medicine Hat is my home stomping grounds. I grew up on a farm 10 miles east of here, a dairy and grain farm. Went to a small school called Irvin way back when. Took my high school at Medicine Hat High. I'm old enough that I was the organist at the Medicine Hat Tiger games when Tom Lysiak and Lanny McDonald were scoring goals. So that's how old I am. So I do appreciate it. I tend to call a spade. And what you're going to get today is my view on global economics, the issues with them, and how they affect you right on the farm. I've got an opinion that varies from the media somewhat. Some of the things I'm going to say today, you won't see in a newspaper because it won't be printed. But the way I look at it is it's no sense denying what's going on in these financial markets right now. I'm going to start off making a bold statement. We are at the end of an 80-year capitalistic cycle that has been already prolonged 10 years by central bank manipulation. It has to be refreshed, and it will be refreshed. And the way I look at markets is that I believe that economics always rule. Central bankers can do whatever they're doing to kick the can, but in the end, economics always rules. I'm a firm believer of that, and that's sort of the basis of my presentation today. So with that, I'm going to start off with what started this whole thing that led into the 2007 financial crisis. You know what? I'm going to blame Bill Clinton, back in the Monica days, okay? Because you know what he said? He said, every American deserves a house. Bill, that ain't right. Not everybody deserves a house. But he said that. And that got the engine starting to go with the banking industry. You got the backing of the president. Now, the 90s were the heydays. That was the .com era in Silicon Valley. And then another statement. Dick Cheney, 2005. Dick said, debt doesn't matter. Dick, it does matter. I remember when he said that. Actually, would somebody have a glass of water too? I could use one of those. That'd be great. Thank you very much. What Dick said really staggered my partner and myself in a log house in Calgary trading commodities. What do you mean? The Vice President of the United States says debt doesn't matter. Thanks very much. So watch me knock this over. And then, in about 2008, Alan Greenspan, after he realized everything was failing around him, and he had been the Federal Reserve Chairman for many, many years, said he thought the banks would control themselves. And what he said was, this is irrational exuberance. Translation, this is fraud. That's the translation of that. And the whole housing market was under issue. So we've got bubbles in this market. The first one was the .com. It expired in year 2000. Mark Cuban sold his company in 1999. That's why he's on Shark Tank now. Because a few months later, this whole bubble really imploded. I had a friend in a place called Walnut Creek, California. And I remember being there in 1999, and I remember it's just out of San Francisco, and everything was about stock options. Stock options this, stock options that. And then it went poof. The next bubble was the US mortgage fraud bubble. And it was really masterfully described in the movie The Big Short. Who's seen that movie? Okay, everybody else that doesn't have their hand up, watch that movie. That is stunning. In 2005, when Dick was saying debt doesn't matter, you could also buy a house in Phoenix for interest only. You didn't have to put any money down. Why? Market's going up. So people with low incomes had 5, 6, 7 houses. They kept buying because why wouldn't they? The market's going up. I only have to pay the interest. We don't have to pay any principal. And that was when we knew in a little log house in Calgary that something wasn't going down. Now, we had no idea of the fraud that was going on in the United States. It was way worse than that. And so it hit in 2007. Now, one thing with markets I've learned is that we can see a trend. But you know what? We're way ahead of the cart. It takes much longer to finally do its thing. And that's what happened. If anybody has seen The Big Short, you watch these guys stamp on their feet saying, this thing's going to break, this thing's going to break, and it doesn't break. It goes on and on and on and on, and then suddenly it goes poof. That's the way these markets are right now. We're going through a cycle where they're supported, to me, some degree, artificially, and then we run into these real little rough spots where they drop off. So in 2017, volatility, okay? We've got a very sleepy market right now. You notice the Dow Jones isn't doing anything? It's just going up and up and up, little by day by day. But that is not a normal market by any means. We're going to see in 2017 this. It's going to start to swing in volatility because economics is going to start to cut into these markets. Then, bubble number 3. This is the kahuna. This is the QE central bank stimulus bubble. What this is money printing. And central banks have 2 tools in the world. Every country has a central bank. They can print money, and they can adjust interest rates. Those are their 2 tools. And right now, the central bank stimulus bubble is now 3 times larger than the .com and the US housing bubble combined. Just think about that for a minute. This is Calgary's economy. Not doing so good these days. I live in Calgary. I can drive down to Deerfoot Trail 130 kilometers. Before it used to be stop and go, going to work at 6 in the morning. Every month I have a breakfast meeting with a group of guys. I'm not sure why I was invited, but I'm glad I was. But one's a developer, one's a men's store owner, 2 junior oil company owners, a part owner of the Flames. It's a really interesting group of men. And I know what they have for breakfast every day. But all we do is sometimes there's not much to talk about, but we each give each other 5 minutes to just say, what's going on? What's going on in the developing market? What's going on in the leasing market? What's going on? And it's a little mini chamber of commerce. And Calgary, right now, which is actually the feeding chain into the Eastern Canadian market through transfer payments from the oil sands, now has 35% vacancy downtown. It is a ghost town down there. There's some towers down there there's a brand new tower that's, how many stories? Sorry, I can't remember the stories, but there's only 1 floor occupied. One floor, brand new. So now the lease rates have collapsed. And the belt line around they're trying to get the businesses around the belt line of the downtown to come downtown. So now the belt line is struggling, and we've got a situation where Calgary has to reinvent itself. Now, it's got a population that is incredibly talented, and it will reinvent itself, but it's going to take a few years. But that Calgary is the hub of the Western Canadian financial industry, if not Canada. It is very, very important, and it's really, really struggling. Our unemployment there is the highest in Canada. The only place that might be higher, unfortunately, is Medicine Hat. Yeah, and that's because of natural gas, huh? In the service industry, we all know that. So we've got an unemployment of 10.3%. Alberta right now is about 9%. The Canadian average is down a bit, but that's all because of temporary jobs. We have to get this energy industry going, and it's going to affect agriculture as well. I like Mr. Bean. He makes a lot of sense to me because he looks at a central banker like that. Says, what are you doing? The new normal is prolonged, slow economic growth globally. Nothing's going to change that. Donald Trump wants to put his GDP up to 3.5%, 4% in the U.S. Good luck, Donald. The GDP in the U.S. in the fourth quarter, I think, will be about 1.6 to 1.8. Did you know, here's a good did you know, that the U.S. debt is so high now that it takes 3.5% GDP in the U.S. just to finance their debt, let alone pay anything down. Like, that's what's happening to the U.S. And who's holding the bag? China, Japan. And how are they doing? So, again, I'm a true believer of economics. Something has to give, is what I'm suggesting. I'm not saying I know exactly what's going to give, but the way we're going right now, it doesn't quite economically hold together. Debt. What's the problem with these markets? Debt. It's government debt and it's consumer overspending. That is the key barometer that's hanging over these markets. 3 years ago, I went to, my wife always wanted to go to New York. So I finally caved in. Okay, let's go. So we got a hotel about a block off of Times Square. And the one thing, Times Square is amazing, but what had caught my eye was the debt clock that's ticking off Times Square. And at that time, it was $14.6 billion, and you couldn't see the end spinning. It was just a blur. When Barack Obama came into power, the U.S. debt up to Barack was up to $9 trillion. 8 years later, one U.S. president, that clock is turning over 20 trillion. One president. And then you get Donald Trump, and he says, I'm going to spend like crazy. I'm going to repair every airport, road, bridge in America. We're going to make America great again. Something doesn't hang together. Whose money is he spending? Sorry, I'm calling a spade, but that's the economics of what's affecting all of us, even people that live in Medicine Hat. That's why Medicine Hat house prices are coming down. That's why Calgary house prices are coming down. Canada. I don't want to get political, but maybe I will. The election promise was a $10 billion deficit. Guess what it's going to be? 34, right? No problem, we're elected. In Alberta, the original estimate was $6 billion. John and I in Calgary said at the time it's going to be 15. That was even before Fort McMurray. it's going to be 15. That's what's coming. Right now, I think the latest estimate is 12, something like that, but it's going to go higher. So that's where we're sitting. And again, Ottawa has created something called an infrastructure bank. I hate these names. Call a spade a spade. Calgary got a brand new terminal, doubled its size in October 31st. Beautiful terminal. International. Not a dime is paid on it. It's all on next generation money. That's what's occurring right now. I've got some good things to say too once we get into the grain, so don't get too depressed. But I did want to set the stage and tell you people what we see, okay? That's my motive, okay? What you hear on the radio is central bank stimulus, okay? I crack up when I hear that. That's a global currency war. It's not stimulus. It's a currency war. They're printing money. So we've got a change in the corporate world. Sorry, I tend to dry out, probably because I'm a little nervous, but it dries me out. Grain or company survival will be challenged. There's going to be companies changing. We're going to see corporate mergers. The next 3 to 5 years, you will just see this going along as we have these mergers come along. And certainly the struggles of brick and mortar. That's going to continue. And certainly the online has really taken that from the brick and mortar. But another aspect of this whole thing is consumerism. Did you know the United States economy is 70% spending, buying cars, going to Macy's? That is the U.S. economy. Donald Trump is trying to get the jobs going through the heart of the United States, which is very admirable, of course. But the biggest factor in the United States right now is spending. They got to keep it going. Now, the U.S. government is saying they're going to hike interest rates. Are you crazy? What's that going to do to consumerism? It's already starting to do this. If the U.S. hikes rates 0.75%, guaranteed recession, without a doubt. Next week, they are probably going to hike it 0.25%, just because Janet Yellen is fearing for her job now. Donald Trump is saying, you got to hike those rates. She probably will. Because U.S. unemployment is now 4.6%. Incredible, huh? It's not 4.6%. It's not even close to 4.6%. The U.S. working force is shrinking like a ball right now. And the people that are falling out, they're not counting anymore. CNN said the more likely estimate is 9.3. I think personally it's higher than that. U.S. unemployment is probably 12 plus right now. It's very serious in the United States, but they only count those that are working in a shrinking ball, if that makes any sense. What good is an unemployment rate when it doesn't call a spade a spade? And that's why I'm griping about that right now. So this Walmart thing I've got here, now I know the Dow Jones has been doing nothing but record highs right now, but when we get into 2017, we're going to start doing this. And we're going to have headlines like this of different retailers that'll have to make moves. Then there's Trumpflation, Make America Great Again. What a great slogan. You could put a football team with that slogan, and probably the Dallas Cowboys. It's a great slogan. But it's on planned massive spending on infrastructure, and the market is buying into it big time. Big time. This is the Trump effect. On the S&P, you'll see that little dip. That's when there was recognition that Hillary wasn't going to win this one. And then the next morning, it went straight back up, and the S&P continued to rise, climbing and climbing, and it's on the idea that this spending is going to generate jobs, which it will. It'll create more employment, more industry, and he's going to get more jobs at home. And the market is full-fledged saying, go, Donald, go. And maybe he's right, maybe he'll do it. But right now, the market is on a high. But then there's reality. Dr. Copper. Dr. Copper, the reason I put this up is copper is the key indicator of global economic health. Because everything we do, use, buy, whatever, has copper in it. It is a major, major building commodity. Now, what's happened? Copper from 215 to present, thanks very much, has moved down steadily, but this spike up at the end is Donald Trump. We need bridges, we need airports. Actually, last week, family holiday, we were in Honolulu. And the one thing that I picked up on Honolulu Airport, it's a mess. Like even the roads in front of that airport are all cracked up. Like the washrooms, they're from 20 years ago. You know, they really do need renovations, big time. You know, compared to our airports, I agree. There's major work. So that work will probably be done, but it's going to be done on the credit card. But copper has taken off like a rocket ship lately. Now, I think, you know, it probably will go higher than we expect, but at some point, promises have to be turned into reality, and that would be the question mark. If they start backing off on any promises, then copper is going to just go in for a dive. So we're going to see that increased volatility in that product. Then we have the Baltic dry ocean freight rate. I look at copper, I look at the Baltic dry. Those are the two key indicators of the world, not central bankers. Not central bankers at all. The reason I put this up is about 2 months ago, and you probably saw it in the news, South Korean major shipping company, a name I can't quite pronounce, went broke. Those ships, I think there was about 18 container ships that were stranded out in sea, but those ships stopped, and the sailors couldn't even get off the ship. Nobody was coming to rescue them. Nobody was going to allow them in a port because there was no money. The South Korean government bailed them out. Now, what the heck is happening? These shipping companies, since the miracle of China broke in 2012, these shipping companies are freighting cargo across the world at a loss. And why are they doing that? Because they're afraid they're going to lose market share. It's a battle for market share on these container ships. And they'll freight it for half price, take a huge loss on it, but at least we got that customer for when the good times come back. Because if we lose it, they'll go to somebody else, and when the good times come, then they've got it. And that's the battle at losses. So what's happening in Japan? About a month ago, Japan had 3 container ship companies. Now they have 1. They've all merged into 1. Now, that means with this bankruptcy in South Korea and the merging in Japan, that there's fewer ships in the water. So freight rates are now starting to go up. You know, the cure for low prices is low prices. Well, that's true in the container industry, but they are starting to recover. But again, that industry is really struggling because commodities are not influenced by central bankers. Commodities are true. In my business, I was a commodity broker. To me, it's the purest form of capitalism I've ever seen. You put your money on the table that the market's going to go up and down, and if you're wrong, you suck it up and you put in more money. It's called a margin call. You know, and it's really a pure form. In the stock market, every time the stock market goes down, who's there? The central banker. We got to keep it up. Got to keep this market going. Even though our GDP is 1.6%. Something called deflation. 3 years ago, I did some work with Country Guide. And Tom Button is the editor in Guelph. And I threw by an idea. I said, Tom, let's do an article on deflation. And at that time, nobody even knew what deflation was, in all honesty. But they said, go, do it. The only reason I bring that up is that we could see it coming. That there was going to be problems and that prices had to break because the economics were not holding. So it was the beginning of the decline of the wealth in the world. Now here's the wild card, geopolitical tensions. And what is that? That's Syria, that's Russia, that's North Korea, that's anybody who shakes their hand and says, we don't like you. Now that is a wild card, because if we get that shake in the markets, suddenly crude oil could go do this, right? It could just shoot up on us. So we're going to see, to me, the geopolitical side of things, and also the trade issues between the U.S. and China. Like Trump saying, well, we're going to make a better deal with China, and China says, well, we're not going to buy your Boeing airplanes, we're not going to buy your iPhones. We got a trade war brewing. So that's a standoff, and I don't know how that's all going to hang together. That'll be really interesting times. That's 2017. That's 2017. So this is the wild card. It's really an unknown. Negative interest rates. Who would have thunk, right? Wow. Why are rates negative? Well, because of deflation. If you print lots of money and you have low interest rates, we should have inflation, right? That's called Keynesian economic theory. Ain't working. It worked with Ronald Reagan, but Ronald Reagan only had this much debt. Donald Trump has this much debt. And when you print your way into this market with a debt load this high, inflation doesn't kick in because the consumer is strapped. They don't have the money. The other thing, why do we have negative interest rates, which is bizarre? This is in Europe, this is in Asia. There's actually bond yields in Canada that are starting to go negative, meaning you put your money in 10 years from now, you take less home. It's because government debt is so high, they can't finance it. If you hike rates to the consumer, you are also hiking rates to the government. The government has to service their debt. The U.S., if they hike rates next week, which I think they might, they're cutting their own throat. They have to service that 0.25% as well. So the rates in Europe have gone negative. There's ideas, believe it or not, that it'll continue to go down. So what's the big product in Japan? Safes. So that no sense giving your money to a bank. You put your money in a safe, and you put it in your house. And I'm going to make a lot of money making safes. And they are. In my trip recently to Hawaii, I've noticed a change in demographics there. 10 years ago, it used to be all Japanese there. Now, it's all Chinese. Really different. You can tell by the height. But I've really noticed it. There's a real change in demographics. The Japanese are not coming now because, of course, there are problems with earthquakes and whatever. And the Chinese are the new rich in the world, and they're starting to travel. Very, very noticeable. Fading power of central banks. Central bankers are no longer a King Kong. And actually, Donald Trump, sorry about mentioning his name so much, but he is in the news, and he's going to affect us. And he said it, and he said the Fed's is not effective, and there's going to be changes. Now, the Fed does not report to him. They're separate. But they no longer, they've pulled two cards. They've dropped rates as far as they can. They can't really drop rates a lot more, right? And they're printing money. The U.S. has already had QE1, QE2, QE3. There's talk of QE4, which, please don't do QE4. It'd be a freaking disaster if we get into that kind of environment. Did you know what Europe is doing? The European Central Bank, do you know how much money they're printing every month? 80 billion euros monthly. And they are still fighting deflation. Keynesian economics out there just go gasp. What do you mean? We should be just, gold should be $2,000 an ounce, maybe $6,000. That's what the internet tells me. It's not. Gold is going down. So we've got the major QE stimulus money. We've got this bubble that's been created. Huge central bank intervention. So what is it? It's a global currency war. You won't see that in the media. But that's exactly what it is. And it's the worst currency war since 1937. That's when the last major one was then. And it was exactly almost identical circumstances. It's kind of spooky, huh? It doesn't mean they're going to follow the same path, but that's part of the capitalistic cycle that's kind of overspent itself. It's got to be refreshed. The U.S. Federal Reserve is protecting Wall Street money now. It's old money. It's inefficient money. It has to be replaced with efficient money and new money. And what does that mean? Cents on the dollar, right? That's the only way out of this. Cents on the dollar. Or, unfortunately, conflicts could be part of this, which we don't want to think about. India. This is a new, I just put this in the last moment because last week India did something amazing. They're replacing all their rupee bills with new rupee bills. And what they're doing is they're saying, hey, you have $3,500 of cash, or more than $3,500 cash, you have to prove to us you've paid tax on that before we'll give you new rupee bills. Because, by the way, in a little while here, the old rupee bills are worthless. So all the mattress money is coming out. All the criminal money is coming out, right? What are they going to do? They got to pay tax on it, else it's worthless. It's called, if I can spit this out, demonetization. Other countries may follow. It's a way of controlling this glut of inefficient money that's out there that really isn't doing anything, and a lot of it hasn't collected tax, and they bring it home and they start over. That started last week, India. So that'll be, I'll be watching that really close because that's the beginning of more countries starting to pull their bills in. I'm not saying Canada. I'm not saying US, but maybe. China's commodity impact. Okay, 2012 was the top of China. The Olympics were 2008. They really had a run. Brazil, they had the BRIC. They had Brazil, Russia, India, and China, a major economic force, the BRIC. That BRIC is not a major force anymore. China started to slow in 2012, and they went from supposedly 14% growth down to a steady 6.5% for the last 3 years, which we don't believe. The government has total control with their numbers. We don't know what China is growing or not growing. All we know is China's debt situation is absolutely massive. But what China has done has affected cattle prices here. It has affected grain prices here. But it's affected Brazil immensely because Brazil is a pipeline to China with their resources. Australia is a pipeline to China as well, and Canada. Those are the three countries that are the most affected, but Brazil's the most affected. So what does this mean for commodities? Demand is king, okay? Case in point, cattle. Cattle were short supply, aren't they? Shouldn't prices hold? I don't mean to push on that, but that's just an example. The cattle market was tight supply. We were told that these prices will continue to go higher into 2016, 17, and all of a sudden feeders went to half price. Why? Demand. We can have, law of supply and demand is you got demand on one side, you got supply on the other side, and that equals price. That's what we're taught in economics school, but in reality it doesn't work that way. It's the guy with the checkbook works, and what he wants to pay, because the supply side has to meet the unsettled demand. And in the meat market, It was reluctance by the consumer for different meats and the prices of meats. So demand is king, not supply. So when you see demand, even on the grain side, buy, then all of a sudden it'll quit and it'll come back down, and then buy. And that's exactly what China is doing with soybeans right now. They're buying soybeans like crazy. It's helping our canola market, and but it's buy, sell, stop, is what China will do. That's typically how they buy. Stock market, totally engineered in my opinion. It's engineered by low interest rates, corporate stock buybacks, and a flow of freshly printed money being parked in the markets. And really, when I say parked, I mean parked. The markets are going, investors are going in there, big pension funds. I saw a story from Bloomberg this week. A Norwegian wealth fund was going to buy $129 billion more in stocks. And I just had to say, that's going to be in a financial bits here in a little while. There's no way. You know, that's just like the Phoenix housing market in 2007, you know, where everybody says, well, that's the only thing that we're getting yield from, so we're going to go there. And the central bankers have our back. So the market is being fed in with this. So to me, this market's quite engineered. And here's the NASDAQ, up and up and up and up. It's historic highs. Here's the Fed. Janet Yellen is attempting to normalize rates. And the reason I put this screen up is that the word normalize from the U.S. Federal Reserve, I dare to be, I disagree with that word. There's no such thing as normalize. It won't normalize. And just to suggest that the United States economy can normalize with $20 trillion debt is insane. There's no way it can normalize. But they are planning to push these rates up. They're telling everybody that's going to be, this year there was supposed to be 4 rate hikes, they had 1. Next year, they're probably going to maybe squeeze one next week, and then 2017 we'll see where the U.S. economy is. It could be very well, in my opinion, that the U.S. Federal Reserve will actually cut rates within 2 years, start going the other way. They have no room to push these rates up. Here's the S&P index, major index in the world. There's a line, I don't know if you can see the 1800 line there, just down below. But if the S&P breaks 1800 on the downside, it's going to start wiping out U.S. pension funds. That's almost at the top. Now I can't, I'll use my finger, but you don't see it. But if you can see the 1800 line, that is where pension funds get into trouble in the United States, because they are all in on this. That's how people are going to retire. So that's a watch. The S&P, if it starts to break, everybody will be gasping if we start moving down to 1800. Watch that one. Power of the U.S. dollar. Since Mr. Trump got in, it's been up and up and up. You can see the little spike down on the, oh gosh, Hillary's not in. And next morning, gosh, maybe things will be okay on spending. And the idea that interest rates in the United States will go up. That's what's driving the US dollar right now, is interest rates, hikes. That's what's driving it. So what if next week on the US Federal Reserve meeting, they don't do it again? Okay, they've called their bluff how many times? They say, yeah, we're going to hike it, we're going to hike it, we're going to hike it. Nope. Sorry, we're not going to hike it. They might. You know, it's possible. But if they were to do that, then the next week the US dollar will plunge. So it will go up if the US dollar goes up or goes down. Every other currency. Here's December gold, the total inverse of the US dollar. Here's, the spike is, Hillary lost, saying we got to buy gold now. Next morning is the hangover that the US dollar is going up. and it pressured the precious metal markets. The gold market, I'm not a big fan of gold. I know there's a lot of contradictory talk about gold, but in all honesty, I think we're going to break $1,000 on gold. I think we're still going down because the physical demand of gold is not that great. And the physical demand from gold comes from India. That's where the big buyer is. Silver, that is a total reflection of deflation. And the silver market, in my view, it's in a trading range between just above $20 an ounce down to about $14 an ounce. That's the range. So it's kind of a narrow band on the bottom of that chart that I think we're just going to chop in that zone for some time. The euro is heading down to US dollar parity. The euro not long ago was about $1.55. Now it's coming down close to, I think it's $1.05 or something like that. The euro may actually, if the US dollar keeps climbing, the euro might actually go below the US dollar. That's amazing. Absolutely amazing. Here's the British pound. That first spike was the Brexit vote, and that's interesting. The market, that first spike up was when the market said they thought no was going to win. They wouldn't separate. And that was the day before, and then overnight they separated. They said yes, and it plunged. And then there's one more dip there. Did you see that second one? That is a flash crash. Now those are spooky because a flash crash, we don't know really what caused it. The only thing I know for sure is it's a lack of liquidity. It's like you've got the parachute on, but suddenly the parachute goes away and there's a vacuum there and you plummet because there's nobody to buy you. And that's what happened there, but nobody's really explained what happened there. But it also pushed the pound down to a lower level once again. Britain's going to fight back. You know where they're going to trade? They're going to trade in India. That's going to be a major. She's already over there making deals with India. So I can see different alignments that Britain's going to go after. Canadian dollar, bullish or bearish? Okay. Believe it or not, I was a little wrong on this one. Quite wrong, because I was a little bit bullish. I didn't think the US dollar was going to do what it was going to do. I thought the US was going to be in a recession by now. I was wrong. US is still hanging in there. I'm probably a little ahead of the cart, but here's the December Canadian dollar, and you'll see it's starting to move up a little bit. It's up to about 75.5 recently, and why did it move up a little bit? It's because OPEC made a bit of a deal to cut 4% of their production here about 10 days ago. Now, whether that deal holds or not will determine, we really are the petrodollar here, but OPEC, if it moves up to, if the OPEC can keep it together, I can see the loonie moving up towards 77 cents, and if it really holds together, we could actually move up towards 78. So that's kind of the range. Now, if OPEC pulls the rug from under themselves and they don't get along, then we're going to fall back. But then again, we have this high US dollar. How much higher can we go? Because as the US dollar goes, what does it hurt? It hurts Trump's manufacturing. He wants to go jobs interior and we're going to just live as an island in the globe. Well, the globe doesn't work that way. He is going to have problems. He has to trade. And the US dollar is going to slow the manufacturing. It's going to slow the exports. And that's why on a product like soybeans, I question it, because right now the US dollar is going up like this. China is buying. They're making good money from the beans, but it's only a matter of time before China says, oh, we're done. And down go the oil seeds. That's typical on these markets. Bank of Canada, key lending rate, 0.5%. It's been there for 8 years. They made another meeting today. Guess what? Stable. Bank of Canada's stuck. They don't know what to do. Right now, the oil range, in my view, is between, and that's the best guess, but I think the low is $35 a barrel. I think right now the high is $55 a barrel. To go $60 a barrel, maybe, but it would probably take geopolitical tension to get there. I hate to say that, but that's what could drive it up. Our recession in Canada began in January 2015. The government has yet to announce that. But we are definitely in a recession right now. So cost of production, crude oil. In Canada, it's about $63 a barrel. That's kind of this is where I pick up from my breakfast boys. That's where I got that from. In the U.S., about 60. Iran, Iraq is about 30. And Saudi Arabia is about 20 to 23. Now, one of the fellows that is in this group was also a plant manager in Saudi Arabia in 1980s, a long time ago. And he said you could basically take a pipe and punch it in the ground and oil would come out. That's how easy it was to extract Saudi Arabian crude. Now crude is getting more difficult, particularly in Canada, to get out of the ground. It's costing more, but they have a huge advantage. But Saudi Arabia right now, the reason why they're pushing for OPEC to make a deal is because Saudi Arabia is going broke. The royal family is going broke. They will be broke. If they keep it up this long, 2020, Saudi Arabia is broke. Can you believe that? One of the richest countries in the world. So that's why a deal is got to be made with OPEC, and that's why the push. It's all about money. Crude oil, here's a chart. Again, the top end of this market, if we do get some skirmishes in the world, I can see crude maybe going up to that $62 area, possibly, but really 55 is stretching it. On the downside, about 35. Here's a little bit closer look. This is the OPEC deal. That's driven the crude up. But yesterday, one member started to balk about the deal. And then crude was down, and the Canadian dollar was down yesterday because somebody balked in OPEC. That's how we're all tied together globally. Natural gas, better news for Medicine Hat. It's finally going up a little bit. And actually, if we have a rough winter, I can see natural gas moving higher. Right now, we could very well go to the top of this range of this chart. There's going to be a beginning, maybe potentially, of some job hirings in this industry. It was the first to break, and it's starting to be the first to recover to some degree. So I'm a low-grade bull on natural gas. I think there's a little bit, but the only thing is that anybody in this industry will have to realize that the old salaries are the old salaries. We have a different dynamic, and different wages will be part of this industry as we move ahead. Grain markets. Okay, this is going to be quick. Corn. Corn is really in a flat market, as you can tell. Now, that's not to say that we can't go up, but the top of this corn market, in my view, if we get something bullish in crude, if crude keeps going up, the corn market will tend to follow to some degree because of ethanol. 40% of the corn market is ethanol, okay? Now, 3 months ago, we were warned by some Chicago traders. This is what they told us. They said, if Trump gets in, watch out for corn. He is not climate friendly, right? And if he pulls these ethanol subsidies, guess where corn's going to go? It's going to start to drop. But right now, from what I'm hearing from him, he's saying it's okay. So corn is holding, but if we do get a move up on corn, the best I can see is that 375 level on the chart. The downside of it, to go back down to 340, 330, sure. But that's the range. It's kind of a muted range. The only way we can get these markets to start to get out of this range is we need a global weather event to get going on these markets. Barley. Barley bids in the Lethbridge area right now, I believe. I know there's many people that buy barley here, but I believe they're sitting around 168 a metric ton. That's about 364 a bushel. For that April, May, some sellers, some growers out there are offering it out at 180. That's about 390. The barley market to me is going to be range bound. It made a nice move up here in October, and in November it started to peel back down a bit. Lethbridge was as high as about 175 about a few weeks ago, and it's weakened off a little bit. The problem is there's no export market. The only market that really might come in is Saudi Arabia, and they use the barley for camel feed, and it's got to be cheap enough to feed camels. So right now we're still too expensive, but there's a possibility. We're thinking earlier fall, geez, maybe Saudis will come in. If the Saudis come in and start to buy, that'll be a first sale in a long time. But they used to buy a couple of million tons from us. Now, if they were to step back in, suddenly we got a different barley market. But right now, don't see it at the moment. And the Vommy wheat that's coming in from Saskatchewan is going to go into cattle rations. It's going to be a competitor out there. I believe some of it's being landed southern Alberta at $155 a metric ton. Again, I don't know what percentage Vommy it is, but that's what I was told. Kansas City wheat. This is Russia. This is what Russia is doing to our wheat market these days. They're discounting it. But I shouldn't say that. The biggest discounter right now in wheat is Brazil and Argentina. That's the biggest discounters. But Russian wheat, Black Sea wheat, Ukraine, they've been very aggressive. So the Black Sea region is really dictating to me where global wheat prices are going. Because Russia's currency crumbled about a year and a half ago, the ruble, and that gave them a huge competitive advantage. Now you got the US dollar doing this, and the US really only has one wheat customer, and that wheat customer is Egypt. And if they lose, and who's been getting Egypt is Russia. It's because of price. So suddenly there's been a shift in market share. And then you have Brazil and Argentina. Brazil right now is actually in a depression. It's not a recession. The Olympics, if anything, pushed them right into a depression. They can't afford that. They've got to pay for that. So it's going to take a while. So they're going to move whatever they can to get money in because they need foreign currency to come back to them. And that's going to be a real push. So on the lower quality wheats, I don't see it going anywhere. But here's the better news, is the Minneapolis market's moving up. And that's because your wheat here was hurt. And the grades, number 1, number 2, CWRS, is in lower supply. And so we're seeing Minneapolis do this, we're seeing Kansas City and Chicago do this. So they're starting to move apart. I think this Minneapolis market's going to go higher. So meaning that if you've got number 1, number 2, that can be blended into those grades, higher prices in the new year, in my belief. But I think if you have the lower grades, it's going to be a little tough to get going, and it's because it goes into that international category. But yeah, if you got the good stuff, maybe, should I say $7? I'll say 7, but it's possible. I think the top bids I've heard is $6.85, if that's fair to say. But I think that's for deferred movement on high grade. Yellow peas, lots of peas. Now, yellow peas were $14 a bushel. Now at harvest they went as low as about $6.50 approximately, and now they've bounced up to about $7.50 thereabouts. Maybe a little higher for deferred, $7.75, something like that. What's the difference? India. Last year India was buying like crazy. And this year they're still buying, but they're not buying as aggressively. And certainly there's currency issues in India right now, but that's a good function of what's affecting our yellow pea market right now. Now it's possible we might see $8, $8.50. I kind of hold my breath on it. The greens, we're started at $8. They're probably at $8.50 now. Possible the greens might go to $9. So that's sort of the top end would be $8 on yellows in my view, and $9 on the greens, thereabouts. Fairly good market, but I don't see the demand and the supply is great enough, and the demand has pulled back that I don't see $10 in these markets right now. Famous last words, I'm probably wrong. Milling oats, I know this isn't probably an oat crowd, but this market is actually in repair right now. And again, that's because of weather in Saskatchewan, Manitoba. The bids are recovering, and the bids are moving now. Even Alberta, Oats, and Edmonton are, I think, $3 or more for deferred movement. Pretty good, for Alberta. Saskatchewan and Manitoba is always the best bid, southern Manitoba, and they're about $3.50. And again, because they're closer to that Cheerios market, where the Cheerios trains go into Minnesota and North Dakota in that area. So, but I like that market because I think the U.S. millers, They only have, really, when you get right down to it, it's our growers here. That's it. The U.S. doesn't produce enough in order to move it, to make all their cereal. This is the March oats. Recently, we've seen a good gain, but it's broken recently for Christmas. Where it is right now, I think it's support. We could very well restart the uptrend in the new year. Canola. Soybeans are moving up nicely right now. We've gone up to about $10.60 a bushel in the nearby. Why? It's because the Chinese love pork. That's why. They want to feed their hogs, and they are buying beans. Right now they've bought about 75% of their year's worth, and we're only in about the second, third month. But that also means that China all of a sudden is going to stop, okay? Just a little heads up. The word cancel will hit the markets, probably in the new year. I think we're okay until Christmas. But that will affect the beans. The beans right now, in my view, overbought, fundamentally overbought, totally. We're going to drop on the beans. In fact, yesterday all I was doing was bean puts with customers. We were using them rather than canola. We feel that the soybeans have more downside than the canola does. Canola's got better demand. This is the soy oil. Now here's the bull side. Palm oil in Malaysia, down 10%, maybe more. It's China's buying the oil. That's stimulating the soy oil. That's giving a draft to canola. So canola's got a weak Canadian dollar. It's got the soy oil going up. It's got the soybeans going up. So crushers making a lot of money. A lot of money, okay? Your basis levels aren't too good right now, are they? Well, profitability at the crush level is really good right now. Here's March canola. We've moved up to that 540 area at the top. Again, because I'm sensing soybeans are toppy, I'm sensing canola's toppy. But if we drop, it's not going to be much, okay? But I can see we might drop 15, 20 bucks. But if we drop 15, 20 bucks down toward about 5.15 a ton, buy. It'll get bought again. And we'll start to go back up. That's my view, because there's just too much damage from harvest that we don't know about. And the margins are still really good on the crushing. Really good. This is November. Keep an eye on November. November trend is up. You know, if old crop goes down, new crop goes down, we're gonna see a bit of a correction on NOV. But again, just keep an eye on this. We're starting to hedge in positions, which is flat out future shorting the NOV around that 510 or higher, getting it off for New Year. Cattle, grief for recovery. What's bugging cattle? Hogs. Hog market just fell apart. And why? Because the meat protein market in the U.S. went into a glut. And beef had to compete against that. And the consumerism in the U.S. started to drop as well. So the retail shift at the counter started to shift. It hurt us in the cattle industry, even though our supplies here was tight. And that's what affected it. Demand is everything. But we're watching the hogs. But in all honesty, the hogs, I think, have bottomed. They've bottomed, in my view. They're starting to move up. This week, the hog prices really jumped. And I think we have finally seen a bottom of the hogs, which is good news. The feeder cattle, this is ugly, huh? Backgrounders, I'm sorry. You took the brunt of this. But it went from $240 at 100 weight down to $120. Half price sale, huh? This feeding cycle was worse than BSE. But the prices are now low enough buying in on new calves, and actually some of the fat cattle last week turned to profit. So we haven't heard that for a while. So that means that the economics, it's starting to bottom out, and we're going to see the market start to gradually move up. Feeder cattle, or fed cattle, up. We've seen Texas move up right up to about $115 recently. They were at $98 as a low here about 6 weeks ago. Went up to $115. Alberta went from $128 up to last week we were at $152 a pound. So we've made about a 25-cent recovery on the Canadian fat cattle market. Now this little break here that you see on the chart, that's called Christmas sales are now covered for retail beef. So in the near term, a little dip in the fed cattle coming. Down, again, I can't point at it, but if you see around 106 there, That's where I'm sensing the February's could correct to, but at that point, it'll get bought again. Markets are always cycles, huh? They always do this, you know? And from my experience, I'm always a seller, typically a seller in the market, so I'm somewhat of a bear, as y'all are well aware. But that's because everybody goes on the bull side. And the bears, we wait and we wait and we wait, we get the euphoria, and then we hit it. And then it steps up, elevator ride down, right? That's how a market works. And you want to be on the elevator ride down. And you want to be protecting those prices here. So I'm going to end with a quick quiz, real fast. 4 key market situations. You got a strong futures. Futures are going up. You got a strong basis. The grain buyer says, please, please, please. What should you do? Price it. Take that grain there. And it's tough to do because at that point, everybody's bullish. Everybody's bullish. But it's tough to do. But when you see the narrow basis levels, you see the futures going up, you see your broker saying technically overbought, sell your cash if you can. But I know it's tougher. It's easier said for me than reality. Strong futures are going up, but the basis levels of grain buyer won't return your phone call. What should you do? Hedge. Hedge signal. Lock the futures only with your cash buyer, lock the futures with your broker, or my favorite is buy put options. Just get puts because there's no delivery obligation. You know, just that's a real key. We see that in canola all the time. When canola futures up, basis levels weaken off, then we hit it on that side. Third one, weak futures. Futures are going down, but the grain buyer is saying, please, please, please. What should you do? Basis contract. That's when you sign the basis contract because you want to lock that basis. You think the futures are going to go up, but you want to lock that delivery basis. Or if you need money, sell the cash, right? And then replace it with call options or long futures. You know, go cash to paper. Cash grain to paper. Just do a replacement. And the last one, weak futures. Futures going down, right? Basis levels, grain buyer won't return your phone call. Worst of both worlds. What should you do? This is where your grain bends come in. But, you know, I realize it's a cash flow component here that I'm not addressing. But just keep that in the back of your mind. So I'll just end there. What we do for a living, I trade in the morning with R.J. O'Brien. There's 2 of us in Calgary, so we're not particularly special, but we just do risk management, basically. Farms and ranches and feedlots. And then in the afternoon, I write about it. It's a report called ProMarket Wire. Thank you very much.
So we'll take time for a couple of questions. People have them?
Yes, sir.
Where do you see the Durham market?
You know, StatsCan yesterday was ugly Durham. It showed a huge increase in Durham supplies. Caught me off guard. I was actually a little bit bullish Durham, and Durham has done really, really well. But given the StatsCan, I think we've plateaued. And it's just because of yesterday's report. You know? Yeah. Yeah, I don't see really any further gains. Feed. You know, I can't answer that. The question is, what's the feedlot capacity? Yeah, I can't answer that. I don't know. That's a very good question. The only thing I'm sensing is that this turn, the background industry will start to make money on calves so long as that we don't get over exuberant like Alan Greenspan talks about the housing market on buying calves. You know, but you know, $3 calves have turned down to $2 calves, and it's sure nice to buy them below 2. But if the calves go to like 2 1/4 or something like that, it's going to be another loss. The reason I'm not so gung ho about the meat is that the U.S. is still waffling in pork and poultry. That's not going to change for a while. Maybe next spring. Yeah, good question. I can't answer it. Yes, sir.
With your outlook on currencies and some of the commodity markets, what's your feeling on land prices in Canada and the US?
You know, that's a different beast. Farmland, yeah. That's a different beast because it's a scarcity of it. People see land come up. They want to finish a block on their farm. There's going to be always those battles. I think the farmland is fairly steady, but in all honesty, we're going to crack a little bit. But it's not like the Calgary apartment prices that have dropped by 50%. It's nothing like that. But steady to a little bit lower is my feeling. Yeah.
Okay, I think we'll end it there. I think we need to move on to the next speaker. So thanks very much for your presentation here.